Hi everybody, and welcome to a brand new episode of Investing with Kurt. In today's video, I'd like to talk to you about basic terminology around investing. A lot of people get intimidated by the fact that they don't know enough about the financial industry. There's a lot of terms, there's a lot of vocabulary that's being used that none of us, to be frank, are, let's say, using on a day-to-day basis because it's not part of what we do. However, I'd like to kind of give you a little bit of a relief to tell you that these complicated terms and convoluted verbiage that people in the financial sector use are actually unnecessarily complicating things for the regular, average day investor. And what I mean by that is that you need to know just a few terms in order for you to be able to invest and understand in what you're investing. It is unfortunate, but it's the reality that the financial industry has created all those terms and complicated set of expressions where it's making it really hard for the regular person to understand, and partially that's that's how they make money. So if you feel like you don't understand, but you want to invest, generally you're going to go and find a broker or find somebody who is financially savvy, and in turn you would need to pay them a certain amount of money in order for them to manage your money so that you can invest. So let me start off first with the very basic thing. If you're brand new to investing, well, what do people usually do in order to invest? They use different, what are called financial instruments in order to buy shares of companies. So a financial instrument is nothing but a stock, it could be a bond, it could be a mutual fund, it could be an ETF or exchange traded fund. Those are all examples of various kinds of financial instruments. But even the term financial instrument sounds very complicated and kind of distant maybe to some of you. So I would even shy away from kind of like those labels and that lingo, and then simply tell you that for you to get started with investing, all you need to know is that you'll be essentially buying stocks or bonds. And when you're buying stocks, that will be usually it can be in two forms. One, you buy an individual stock. Let's say you want to buy Facebook or Amazon, so you can buy that individual company's stock, or you'll be buying multiple stocks all grouped together into what's called a mutual fund. And mutual fund, by the way, that's really a recommended approach for the average investor to, one, reduce risk and to increase diversification as they're trying to invest. So if you buy one share of a mutual fund, you technically own a little teeny bit of pieces of, let's say, multiple companies, maybe 100, maybe a few thousand, depending on the mutual fund. Another variation of that, let me call it a variation because it's a different financial instrument, but it's very popular nowadays, is an ETF. And ETF it's an abbreviation for exchange traded fund. And what that means is just another way for you to buy a piece of a company with those ETFs. They vary slightly in characteristics from mutual funds, but I'm not going to go into that because I believe it's going to be a little bit overwhelming, especially if you're starting out. All you need to know is that if you want to start investing, you can buy an individual stock, a single company, Facebook, Google, Apple, all good candidates for that. Or you can buy a mutual fund, which is multiple companies clubbed together. Or you can buy an exchange traded fund. Now, another type of financial instrument that you can be investing in or using with is bonds. And bonds are slightly different than stocks, mutual funds, and ETFs, which are in general called equities. Bonds belong to a slightly different type of investment tools, as they're more about lending somebody money, your money, in exchange of them promising to give you a certain return or a certain coupon. And bonds are usually historically considered safer or less risky or less volatile. Each one of those could be correct at a certain point in time, but in general they're considered less volatile because they're less risky. And because they're less risky, some people like using bonds to basically give them a little bit of a return, maybe match the inflation that we get almost every year, but then, you know, they don't risk too much. So it's just another form of financial instrument that you can invest. Now, you can basically look up any one of those financial instruments, whether that's bonds or stocks or mutual funds, by using their ticker. So each one of those types of offerings from the stock market is associated with what's called a ticker. And you can go to different websites like Google Finance, Yahoo Finance, Morningstar. Those are all good websites where you can look up a ticker, and basically that's the short name of a company on the stock market, and see how that company is doing. In case the ticker represents a mutual fund, you can see how that particular mutual fund is doing in the stock market. And that's useful because usually the more information you can get about a stock or a mutual fund or a fund simply, the better you are in terms of making a decision whether that's a good investment for you or a bad investment. It's a different story when it comes to whether you should make a decision based on recent performance or historical performance of a fund, but that's a topic for another video. Generally, history is all we have, so we can learn from the history of a fund. We can see how it has performed, but it's not a guarantee that it will continue to perform in the same fashion. At any rate, so you can look up funds that you're investing in by using their ticker on common sites like Google, Yahoo, Morningstar. The other thing to know about is stock exchanges. So there's, in the US, there's, obviously New York Stock Exchange, but if you're somebody that is not living in the US, maybe you don't want to invest in the US Stock Exchange. There's other exchanges. There is London Stock Exchange, there is the German Stock Exchange, there is the Japanese Stock Exchange, there's the Chinese Stock Exchange. So there is various kinds of stock exchanges which you can use in order to invest. And a stock exchange is, think of it as a marketplace. So it's a store through which you can buy those different funds, stocks, mutual funds, etc. And the stock exchange, depending on which part of the world you live in, you may choose one stock exchange versus the other. Let's say if you're in the US, it definitely makes sense to use the New York Stock Exchange. If you're based in Europe, maybe you don't want to invest in the New York Stock Exchange, maybe you want to invest in the London Stock Exchange, or anywhere in Europe that sort of makes sense for you geographically. Now, the reason for the existence of these stock exchanges is that for you, they serve, as I mentioned, as a marketplace for you to buy shares and sell shares. It's a really convenient way you can do it. It used to be that in the past, you had to go through a broker, you had to pay somebody money and all kinds of fees in order to get a particular stock or a piece of a mutual fund. But nowadays it's very common, it's very popular to simply use online brokers, which are basically brokerage companies which give you an account. It's like a bank account. And as long as you have a brokerage account, you're able to operate with the funds that are in that brokerage account and buy funds or sell funds. So pretty simple. Now, the one thing to also know about when it comes to investing, another set of terms that I like to really stress that you should be familiar with and those are around fees and expenses. Fees and expenses are important because pretty much every fund would have like a different expense ratio. And you already see that I'm already using a couple of terms around fees. So a fund's expense could be called an expense ratio. It could be called load fees, no load fees. You'll hear terms such as management fees. Those are all fees that you need to be aware, because as a investor that wants to make the most out of the stock market, you should be really focusing on low-cost funds, and funds which don't charge you a management fee every year, funds which don't charge you a load fee, and funds that don't charge you a fee as you want to take money out or sell your funds rather. Let me spend a little bit of, let me clarify a little bit each one of those types of fees. So typically, when you buy a mutual fund, for example, the one thing to definitely look at is what is the expense ratio of that mutual fund. And the expense ratio is usually the expense or the fee that you need to pay every year to that mutual fund because you own, let's say, a chunk of that fund. And expense ratios can vary greatly. It can be from 0.05%, it can range to 1 or 2%. So depending on the fund that you're looking at, expense ratios could be pretty high. And you want to avoid, in general, the funds which have very high expense ratios. Typically, those are funds which are called actively managed, meaning there is an active manager, there is a person or a team of people that are actively managing the fund, and as such, they are charging a fee to you if you want to buy that fund or shares of that fund. So, again, topic for another video, but what I want you to take out of this definition is that you want to look for funds and shares and whatever you buy in ETFs that have very low expense ratio. Apart from the expense ratio, there can be other hidden fees that you may not necessarily see immediately as you look at that fund. Typically, when you go into a site like Morningstar, they will publish the expense ratio and they will tell you what that is. But also sometimes you may need to read the prospectus of the fund or look at a bit more details in the fees and section, because there you may see things like a management fee. And a management fee is basically another way to say that the fund will charge you a fee to manage kind of the money that you're putting or buying the funds that they're offering. And the management fee, the bad thing is it occurs every year. So if the fund has a high management fee, again, it's something to consider. You probably want to avoid that fund. Another fee that you need to look at also is, especially if you don't want to find this the hard way, but when you buy a mutual fund or a fund of some sort, they may have what's called a load fee. And that fee basically is charged every time you want to buy a share or a piece of the stock, then they will charge you a certain percentage. So that's kind of like an entrance fee. It's a cover charge for you to own that stock. So, and it's basically proportional. So maybe it's 0.5%, maybe it's 1%, maybe it's even 2% load fee. Load fee, usually it's a one-time fee, and it's associated with every purchasing that you're doing of the shares of that fund. So unlike the management fee, it's not a recurring fee that you have to pay every year to the fund. However, every time you want to buy new shares or additional shares of that same fund, you would have to pay that load fee. Another type of fee that you also need to watch out for is the fee that's being charged from some funds to basically sell or take money out of the fund. and that fee is not as common, but depending on the types of funds that you're looking at, it could be, again, a sizable amount or a percentage that you don't want to be paying. So just like management fee, just like a load fee, the fee that you need to pay as you sell your funds, you want to make sure that it's either there is no such of any of those three types of fees, or if there is, it's the minimal amount. My personal advice is to look for funds, mutual funds and ETFs which are passively managed. And the passively managed funds usually have only one type of fee, and that's the fee that is published under the expense ratio of the fund perspective or overview. And the expense ratio of passively managed funds is usually a very small percentage. It's usually for stocks like which are basically representing the S&P 500 index, that's usually in the realm of 0.05%. That's very, very low. It's minimal amount of money that you're paying to hold that fund and to own that fund, rather. There's also indexes which are somewhat passively managed, but they may have kind of like a higher expense ratio. They may go up to 0.4% or 0.5 or 6%. For passively managed funds, that's considered on the high end. So if you have other options, I would consider expense ratios lower than 0.4%. Depending on what's available to you, maybe looking at your 401k, or maybe you're limited to a certain online broker, or maybe, you know, in your part of the world, ETFs and mutual funds cost a little bit more. You're not able to get rock bottom low prices. Then you look for expense ratio that is maybe up to 0.4, 0.5. For me, it's borderline. It's kind of expensive. Now, let me talk a little bit about what you will be buying as you want to invest. And what you will be buying is essentially a mixture of stocks and bonds. That's typically how a portfolio is constructed. If you're in your early 20s, you probably want to have not a lot of bonds. You probably want to bet more heavily on equities because they offer you higher return. Yes, they are riskier, but you being younger, you can take the risk because you supposedly would live quite a few more years, so you have the time to basically weather the storms and wait until the market goes down or up or down or up, and then ultimately make a lot more money with time. So you'll be buying a lot more equities or stocks and shares of mutual funds and ETFs, and you'll probably have minimal amount of bonds, if any. Now, that ratio of how much bonds you buy and how many stocks you own in terms of a percentage between the two is often referred to as your asset allocation. So when somebody mentions what is your asset allocation, usually what they mean is how much of your portfolio is in stocks and how much is in bonds. There is a number of kind of common asset allocations. A very safe one or very common one is a 60-40 asset allocation. You're holding about 60% of your portfolio is in stocks and 40% of your portfolio is in bonds. That's a very good mixture of stocks and bonds, but depending on your age, that may or may not be optimal. Also, depending on your risk tolerance, that may or may not be kind of what's good for you. So I'll leave it at that. Just be aware there's this thing called asset allocation, and you may want to read about it, you may think about it, you know, what would be your asset allocation based on the kind of like risk tolerance you have. Then apart from the asset allocation, another thing to think about is also asset classes. So as you want to invest, you want to think about what are the asset classes that you want to invest. And an asset class is nothing but a grouping of stocks or equities that are basically have common characteristics. For example, there is large companies which comprise a asset class. Usually for short, people call it large cap companies, which are large capitalization companies with billions of dollars. There is mid cap, there is small cap, there is value stocks. Value stocks comprise their own kind of asset class. There is also growth stocks, which are also an asset class of their own. So usually a portfolio is a mixture of those asset classes, and that's the best thing you can do. You want to have a representation of all of those asset classes. Now you can go a couple of ways about it. You can buy a mutual fund of each asset class so that you own all of the asset classes, or you can buy a mutual fund which covers all asset classes. Both of those are common. You would find plenty of mutual funds, plenty of ETFs which give you all of those options. I'll leave the recommendation of which way to go to another video, but just be aware that there's asset classes and you have multiple strategies to go about it. Ultimately though, you want to be diversified, so the more asset classes you own, or the better diversified your mutual fund is, that translates to owning multiple asset classes. So with that kind of background, I also would like to jump a little bit to the computer and show you, what to look for when you're looking at a fund or a stock. So I'll go to the MarketWatch website. By the way, no affiliation whatsoever. I just think that they do a really good job representing that information. And I'll show you some of the things that you need to be looking at. So obviously there's going to be a lot of things you'll see in a second, but I'm going to highlight just a few of those terms that I mentioned, and I'm going to highlight what are some of the most important entities within that description of a fund that you need to be familiar with and you need to understand. And once we do that, I believe you'll be a bit more comfortable, especially again if you're just starting out, knowing what it is that, what are stocks, what are bonds, and how you can look up things in order to understand what you should be investing in. So let me jump real quick to the computer and show you a couple of examples.